In 2025, a quiet rule change flipped U.S. real estate negotiations. Buyer agent fees are no longer baked into MLS listings by default, and that single shift is reshaping contracts, closing costs, and who pays what at the table. Today, we will break down exactly how this affects buyers, sellers, and investors, and how to structure your next deal to win. Let's start with what changed. After the National Association of Realtors settlement, MLS platforms stopped publishing offers of buyer-agent compensation. Instead, buyers and their agents must sign a written agreement that spells out how the agent gets paid and who covers it. This went live in August 2024, and here in 2025, the ripple effects are everywhere. Now, you might be asking, did commission rates collapse? Surprisingly, they didn't. Rates dipped for a moment and then bounced back close to 2023 levels. The difference isn't about the percentage anymore. It's about who pays, how it's disclosed, and when it's negotiated. And that shift changes your strategy, moving into the buyer's perspective. So let's talk about what this means if you are buying. The first thing to know, you can't even tour homes without a signed buyer-broker agreement. That document locks in your agent's duties, fee, and how that fee will be covered. Skip this step, and you will run into roadblocks fast. The second point is about budgeting. If the seller isn't offering to pay your agent, that cost may fall on you. That means higher cash to close, or negotiating a seller credit to cover it. And here is the catch. If you don't handle this early, your lender's disclosures and debt-to-income ratios may not match, which can throw off underwriting. Now, moving forward, let's talk about negotiation. Smart buyers are requesting concessions that specifically cover buyer-agent fees. This keeps your out-of-pocket lower and ensures the loan estimate reflects the true picture from day one. And finally, for investors, this is even more critical. If you are qualifying using rental income, a surprise shift of fees from seller to buyer could nudge your DTI just enough to disqualify your loan. Plan, model both scenarios, and make the fee strategy part of your offer, shifting to the seller's role. All right, now let's flip perspectives. If you are selling, you are not required to offer buyer-agent compensation anymore. But here is the reality. Many sellers are still choosing to offer concessions that effectively cover it because it expands the buyer pool and makes offers stronger. Think about it this way. You can package a credit for closing costs, rate buydowns, or even agent fees. Buyers under pressure for cash love this flexibility, and it can mean more showings, but here is where you need to be careful. Your listing remarks, the offer contract, and the lender disclosures all have to match. If they don't, you risk tolerance cures at closing, meaning you or the buyer gets stuck with last-minute fixes. The best defense is consistency from the start. Moving on to agents and compliance. Let's talk about agents for a second. If you are representing buyers, compliance is your lifeline. You need a written buyer-broker agreement before touring. You must clearly disclose that compensation is negotiable, and you need to document the conversation about how fees will be paid. No shortcuts here. And don't forget lenders. The Mortgage Bankers Association has already flagged a big pitfall. Deals blow up when buyer-paid commissions aren't factored into the loan estimate and disclosures early. That means looping the lender in on the compensation structure the moment you draft the offer, not later. The market data reality check. So, where do we stand? A year in, data from early 2025 shows commission rates dipped, then rebounded. Most buyers still didn't negotiate fees directly. Many assume it's just part of the deal. But the real difference is that the negotiation table has moved forward. The discussion happens before the first showing, not at closing. Translation? The system didn't collapse. Instead, planning and transparency became the new currency. Now, let's talk about underwriting and appraisals. This is the area most investors don't think about, but it's where deals stall. If a seller concession is mislabeled or a buyer fee isn't disclosed until late, lenders may require redisclosure, appraisals might not align, and closings can get delayed. That's why your deal team needs to finalize the fee strategy before ordering appraisals or locking disclosures. It saves headaches, and it protects your timeline. Moving forward into practical playbooks. So how do you actually apply this? Let's run through a few quick playbooks. If you are a buyer, especially an investor, sign your buyer-broker agreement early. Negotiate a seller credit to cover fees if cash is tight. Run your debt-to-income models with and without that credit. Share the plan with your lender before the loan estimate goes out. If you are selling, decide upfront if you will offer concessions and how much. Spell it out in your listing remarks and carry it into the contract. Use a net sheet that shows 3 scenarios: full price with credit, price reduction with no credit, and a targeted concession like a rate buy-down. And if you are an agent, always have a signed buyer agreement before showings. Disclose that fees are negotiable. Decide on payment sources early. Keep everything consistent across contracts, lender docs, and appraisal notes. So here is the big picture. Commissions didn't vanish, but the rules of engagement changed. Buyer-broker agreements are now the foundation. Sellers can still use concessions as a strategic weapon, and everyone, buyers, sellers, and agents, must bring a fee strategy into the conversation earlier than ever before. In 2025, transparency isn't optional. It's the only way to close smoothly, stay compliant, and protect your deal. If you want a fill-in-the-blank buyer-broker agreement prep sheet and a commission concession calculator, book your free consultation today at gavtax.com. Don't forget to like, subscribe, and share this with someone closing a deal this year. See you in the next video.